All right. Good morning, good afternoon, good evening. Special Labor Day edition, YouTube Live with Matt the Mortgage Guy. In today's video or today's live, I want to talk about, can you afford to buy a home in 2023? And notice the words I used were can you afford and not can you qualify? Because ultimately, I talk to hundreds of people every single month. And the question you ask is not how much do I qualify for, but how much can I afford? And how much I can afford is a question as the consumer, as the buyer, better than I do. And I'm going to help you by showing you the numbers, by looking at it at 300,000 with 10% down. What does that payment look like? Is that something that fits into your budget? At 400,000 with 5% down, what does that payment look like? Is that, something that I can realistically afford based on how I spend my money? Because the problem with how lenders qualify you is they take a debt to income ratio. Here's what your income is. Here's what debts that show up on your credit card, or I'm sorry, on your credit report are, credit cards and car payments and things like that. And then if by their calculation, the debt to income ratio works, you qualify. What it doesn't factor in is how much a month do you spend on food? How much a month do you spend on extracurricular stuff? Maybe you've got two kids that are really active in travel sports, and that costs you $1,000 a month between a couple of them. So those are the things that I think you, the consumer, or you, the buyer, need to take stock of, take accountability for, and figure out for yourself what you qualify for, right? The question is to be answered by you, not by a math equation or a loan professional, right? I'm here to help and guide, but I think what I encourage clients of ours to do, and I encourage you to do, come up with the answer to some of those questions on your own. So I'll go through some scenarios here. Thanks for joining. As always, fire away. Unlimited questions. If you've got a question in the comments, rest assured by answering your question and hopefully helping you out, it's going to help out tons of others that either watch it live or watch it on the replay. So fire away with your questions. Thank you, all-nighter, hider. Hit the like for this guy. I appreciate that. Smash the like button, whatever they do for the YouTube algorithm. The kids still say that. They used to say that. Good morning, Gio. Thanks for joining. I appreciate you. Kevin Hawthorne, as always, thanks for the love from Lakeland, Florida. I appreciate you. Matt, what is the average price for a single family home in California? Well, if you took an average in all of California, I honestly couldn't tell you that number, whether it's 580,000 or 625,000. It's rather irrelevant, though, in my opinion, because there's going to be some really nice areas where the average price is 1.1 million. There's going to be other desert areas where I know that the average price is 210,000. So it's a very wide range. And there's certainly different parts of California. Where I currently reside in Sacramento, California, up in Northern California, that the average price for a single family home, is going to be between $500,000 and $600,000 for somebody at the entry level. Of course, there's nicer neighborhoods that are more expensive. There's lesser neighborhoods that are less expensive. There's bigger homes in nicer neighborhoods that are way more expensive. There's little itsy bitsy homes in the not greatest neighborhood that you might get for 300,000, right? So there's a lot of that. But really, for today's exercise, average price for the whole state, all of this stuff is really irrelevant. As a buyer, what you want to do, and I'll show you because I'm going to basically pull up the screen and I'm going to walk through a few different scenarios. What you want to do as a buyer is figure out what works for you and then go from there. So you want to connect me and my team, as always, greatmortgagebroker.com, fill out the form. We'll really dial in your numbers, which eventually you have to do. If you want to buy a home, you need to get really intimate with not only what you qualify for, and that's by filling out an application, supporting docs, having a lender review it. But then, like in today's exercise, we're going to do figuring out what you actually can afford, what fits into your budget. So I will share my screen. I'm going to share this window. Hopefully you guys can see this, an Excel spreadsheet. I've got it pretty zoomed in, so it should be relatively clear for you. What we're looking at is a 10% down home purchase and a 5% down. I could show you 20%. I could show you 30%. I could show you like, look, payments aren't that expensive. The average first-time home buyer puts something like 7 or 8% down. So a lot of 5%, a lot of 10%, some 3, some 3.5. And of course, some people are blessed enough to be able to put 20% or more down. But here's where most first-time home buyers live, with 5 or 10% down. And so when I tell you, figure out what you can afford, you're going to know what fits in your budget. If you're paying $2,000 a month in rent and you've got $500 or $600 in funds that you've been saving on top of that every single month, then a $2,200 a month or a $2,300 a month payment is not necessarily going to be something that is going to be tough for you to make month on month. And that's what you want to figure out, right? Not only can you make the payment every month, but are you able to continue to live the lifestyle you want to live, travel, all the other things, right? And so some real quick stuff to mention: 300,000, 10% down, 6.999% interest rate, 2,200 a month, we'll call it. Principal and interest, taxes, insurance, and mortgage insurance, all in about $2,200. And, you know, roughly speaking, the third-party fees, title fees, prepaying tax and insurance, all the stuff that goes into it, just expect, you know, that's going to be about $36,000 total cash to close. Or if you do 5% down and you're out of pocket only $21,000, here's what your payment's going to be. And this is the type of analysis like you want to do in your personal scenario. I can't go through 1,000 different scenarios. I'll go through like a 400,000 and a 500,000, but this gives you an idea and some of the conversations you start to have with your mortgage professional or with yourself or with your spouse or with your, you know, partner that you're buying with is, hey, we've got $50,000 in the bank. Do we want to spend 36 of that up front and have 14 left and pay $2,200 a month? Or maybe we conserve a little bit of capital. We got 21,000 in outlay and a $2,300 a month payment, and we still have 29,000 left in the bank. You know, looking at these side by side, for most people, it's going to make sense to have an extra $15,000 in the bank by putting 5% versus 10%, and the payment's only about $100 a month difference. Now, every scenario is different. If the credit wasn't as good as it is in this scenario, then maybe the difference in mortgage insurance would be more than $11. And then you'd lean towards 10% down, or, you know, a tons of other factors, right? Maybe you don't qualify with 5%. Maybe the payment's got to be under $2,200 for qualifying purposes. These are all great things to look at and consider. I'm going to toggle back between this and questions. So keep firing away with any questions you got. I'll just plug in 400,000. You know, different people in different parts of the country, the numbers are going to vary, but same thing, 5% down, 10% down. With 400,000 and 10% down, your payment's about $2,900 a month, $2,930 here, with a good estimate in here for homeowners insurance of $850 a year. This is going up in a lot of states. This is going up in a lot of places, so it could be higher. But principal and interest at the 6.99 rate, property taxes. This again is based on my home state of California of 1.25. If you're in a state like New Jersey, where property taxes are ridiculous, that number is going to differ, but gives you a good idea of, you know, call it $2,930 for 10% down, and then $3,078 all in for 5%. And then again, you look at total cash to close. These are all estimates. This is not an offer to lend. I plugged in some numbers based on a sheet I had done recently. So this is not an offer to lend. All these numbers are just estimates. And for entertainment, educational purposes only. I probably got to say that, especially being in California, because someone's going to, don't sue me, bro. All right, let's do 500 grand for S and Gs. And this is where you start to see that some of these higher priced areas, it's tough for a first-time buyer. For a first-time buyer, and let's look at the right-hand column, 5% down, $3,848 a month is a big deal, right? It's certainly not near the levels of affordability we saw when interest rates were hovering around 3% just a few short years ago. So this is a good intro from here into something that I haven't even set up. So I'm going to click on it, but I'm going to have to make some edits. A 2-1 buy down where somebody's like, man, 38.48 is, quite an expensive payment. Don't know if I can swing it. If there was the ability to get some seller credit, and I got to adjust the numbers because we've got a 3% down scenario in here. I'm going to make it 500,000, and we're going to make this 10% down. The mortgage insurance is going to be a factor of 1.9. Me having to tweak all this stuff is another reminder to you as a buyer. Every scenario is so unique that to give blanket mortgage advice, very, very hard. But I'm able to tell you and show you. I use the 22 factor here. Yeah, homeowners insurance is going up. So I actually upped my estimates here. A $500,000 house, I think 1,100-ish a year is a good guesstimate. But let's look at this scenario. 10% down, $500,000 purchase. I realize this is kind of small. So let me try to make these bigger. All right. Hopefully that's more legible. And we'll do the same 6.99. And with this buy down scenario, it's 499 the first year, 599 the second year, 699 year 3. What you'd be able to do is go to here, 450, 6.99. You got a trusty calculator for the 2-1 buy down, 6.999, and say, how much of a subsidy do we need from the seller? If it's hard to see this, trust me when I tell you that, come on, get bigger. Whoop, too big. 10,488 is what's needed from the seller in subsidy to do this buy down. So can I make it bigger? There we go. People can see that. If you get 10,500 in credit, you're gonna be able to structure it like this, where like, oh, it's rather expensive for me, but if I do 1.9, that was 5% down, huh? I was doing 5% down to show that 0.15. No, 0.19. That's right. Okay, so this is 5% down. That's the proper mortgage insurance number for it. This is going to be tough for a first-time home buyer to jump right into a 38.48 payment, right? So get yourself the needed 10,500 in credit, knowing that, okay, I can ease into this new mortgage payment, 32.37 in year 1, 35.35 in year 2, and then 38.48 in year 3 through 30. It's a 30-year fixed, and so it never goes above this 6.99. We just have a subsidy in years 1 or 2. Ideally, we're at a place where you can refinance 12, 18, 24 months out, 5.5% 30-year fixed, 5.75% 30-year fixed, where your payment, if we plugged in 5.625, let's call it $3,400 a month, and then it's stuck there on a 30-year fixed. Worst case scenario, you're still in a fixed rate payment, so not the end of the world. But this, for a lot of the clients we're working with, allows them to ease into what is for most people a step up. The mortgage payment that you're going into, if you're buying a house in the similar neighborhood, is going to be a step up from your rent. So ease into it with a 2-1 buy down, and might be an opportunity to refinance. If you do with the 2-1 buy down, which is a lot more popular nowadays, if you refinance before the 2-year period, any unused subsidy goes back to you in the form of a principal pay down. So enough with that. I'm going to take that thing down and then just see if we can answer any questions. Ezo Brown, thanks for joining. Can we have a copy of that spreadsheet? Happy to deliver it to you. Just know that there's some things in there that aren't protected. So there's formulas for property taxes and homeowners insurance and all that stuff that are estimates based on some California purchases. You either would have to adjust them for your area or know what the taxes and insurance are. I'm happy to send it though. If you fire off an email to team@mtmg.com, we'll send you that spreadsheet for quoting purposes only, and not an offer to lend, but will be helpful. You know what I probably need to do? I probably need to have the spreadsheet available to you, and then a tutorial video where I can walk you through exactly how we put it together, what cells you can change, and everything will auto-populate what cells to stay away from. Eventually, I'll take one and I'll nerd out enough to where I'll have protected cells where you can't adjust them. But for now, happy to share it with you. Happy to have you mess around with it and whatnot. The trick is mortgage insurance based on your credit score is the factor is going to change. Property taxes based on where you live, the factor is going to change. Homeowners insurance based on where you live, the factor is going to change. So if I'm doing something for somebody in California, I give them a spreadsheet that's for them in their area. And I don't have, enough capacity to say, here's a Sarasota, Florida spreadsheet. Here's a Memphis, Tennessee spreadsheet. Really, some of the stuff changes over time. Mortgage insurance factors, homeowners insurance rates, and all that other stuff. But for the generic one that you can mess with, more than happy to just fire me an email, team@mtmg.com. All right. Ezo Brown, great question. Can I use that 10K for a permanent rate buy down? Yes, you can. The problem is in the scenario like I did where we're 499, 599, 699, the permanent buy down might be 6,499 or 6,375. And so you'll permanently buy down to 6.375, and that's great, although it's nowhere near what you'd be in years 1 and 2 with 499 and 599. And on top of that, if you refinance out of it in 12 months, 15 months, 18 months, that whole 10K is gone. It's vanished, right? With the 10K permanent buy down, where if you refinance out of a 2-1 buy down a year in, the whole year worth of subsidy goes back to you in a principal pay down. Yeah, it's not going to make a lot of sense to be paying a bunch of buy down points in this current environment, Ezo Brown. One, it's a sunk cost and it's gone forever. And two, the 1-0 buy down or 2-1 buy downs are just a lot better option. And the money's not sunk. Any unused portion of it, if you refinance, goes towards a principal pay down. How hard is it in practice? Flash a light. Thanks for joining. Appreciate you. How hard is it to get a second FHA or VA loan due to forced relocation for a job? Not very difficult. Those two different loan types are going to have different criteria. With a VA loan, it's more going to depend on how much eligibility you have left. And if you're keeping that first VA loan, a lot of veterans have enough eligibility to go buy another property using the remaining eligibility they have. And it's a calculation that lender can run for you and pull those numbers to the side and show you how much eligibility you have left, what you qualify for on the second VA purchase. If you don't have enough eligibility left, you can put more of a down payment and still buy the home. So I know that it's really, really common for veterans to use their VA loan multiple times for multiple properties in multiple states, because you guys are getting relocated all the time. When it comes to an FHA loan, if you move at least 100 miles away, or you've got a family size growing, I've got a video on the exceptions for a second FHA loan. It's certainly possible. It has to be a real move, a real exception to their rules of only having one FHA loan. But for sure, if it's legit, you'll be able to do it no problem. Hopefully that helped you flash a light. Keep the questions coming. This special Labor Day edition is for the people. So any value I can add to the people, any questions I can answer for you, I'm more than happy to. I've got some spreadsheets that I'm happy to share. What else do we got here? I try to keep these purchase scenarios relatively simple because it can be overwhelming. We've got some FHA versus conventional. Just looking through some random scenarios. See which ones might make the most sense. If you want to connect with the team, greatmortgagebroker.com. All right, let's pull up FHA versus conventional. I think this is probably one that's coming up more this year than in prior years. Holy moly. Okay, again, not an offer to lend. This is just a side-by-side comparison so you can see. And actually, in this case, it's really, really close. But depending, well, I guess it's $170 difference. All right, let's share this one. Share screen. And this will give you an idea. Let's say you got a 685 credit score and you're thinking about putting 3% down conventional versus 3.5% FHA. This would be the kind of thing you'd look at. I'm going to make this a little bit bigger, hopefully big enough where we can see it. 3.5% down FHA on the left, 3% down conventional on the right. If I scroll all the way to the bottom quickly, with all the prepaid taxes, insurance, all the other things, since you're putting an extra 0.5% down with FHA, it's roughly $2,000 more out of pocket. in this specific scenario, but rate is much lower. And even though the MI, the mortgage insurance, is slightly more expensive, you're saving $170 a month. Stand by while I price this, because I don't think that the mortgage insurance is going to be cheaper with 3% down unless you have really good credit. So let me try to do $390 purchase price. And just for this, just for the sake of this, because this is just an old scenario that I dug up, I'm going to call it a 680 FICO. When you get between 640 and 680, a lot of times you put these side by side, FHA is going to be the clear favorite. But for this scenario, I'm going to say 680. 3% down. Yeah, so $224 a month, which still $224. 65 is $205. 70 factor is $221. Is it like a 71? $224. There we go. Okay, so it makes it even more clear in this case if, oh my gosh, this is so old that it's an old factor. 0.55 is the new MI factor for FHA. So let me dial this in. It's going to become super clear that, okay, so this is dialed in. You're going to pay about a half a point for a 7 1/4. Get a 7 1/8 for half a point. Now, let's go FHA. Go 3.5% down and see what we're working with rate-wise. Same half a point. Oh, we didn't get much lower. Oh, that's because we're still unconventional. Huh. All right, FHA. I was like, man, I know FHA is going to have a lower rate at a 680 score. Elite FHA. Yeah, so that's more like 6.499. $180 a month cheaper. $178 a month cheaper. I know I did a lot of different calculamentations there, but for the most part, that's about apples to apples. What you're going to get for the same cost up front rate-wise, you're going to have cheaper mortgage insurance with FHA. You're going to have a lower rate. And so in turn, you're saving $180 a month. The extra 0.5% down means that you're out of pockets about $2,000 more. This is small writing, but $26,800 on the FHA side, $24,770 for 3% down conventional. Because remember, another important thing for people to remember, because they forget it quite often, is you're buying something for $400,000 and you're putting 3% down. That's $12,000. It's not over. You still got some upfront costs when it comes to title fees. There's lender fees involved in most cases. You're going to prepay property taxes, homeowners insurance. Sometimes with the purchase, there's transfer tax, depending on how the contract's written. So, you could probably prepare for an extra anywhere from 1.5% to 3% in quote unquote closing costs. Now, you can get credit, help cover some of those, or in some cases, the seller might split title fees. The seller might pay the transfer taxes and all that. But know that your 3% down doesn't mean 3% down is the final figure for money out of pocket. You're going to end up in most cases probably around 5%. So you buy something for $400,000, you've got 3% or $12,000 in down payment, and another $8,000 prepaying taxes, prepaying insurance, some title fees, some lender fees, some transfer taxes, and all that other stuff. So just know that, be aware of that. Make sure that you're seeing something like I showed up here, dialed in scenario that shows you exactly what those different costs are. Ezo Brown, what's the closing cost? It's funny, I went there before you had asked it, but since you did ask it, I'm happy to show this. You know what I think I might do too is these types of things, in my opinion, are things that not everybody's getting when they're going out there and looking for a home and realizing they got to get a home loan to do it. So I might run like a monthly home buyer workshop. I'm going to go back through it because I think it's a good question, Ezo Brown, just like kind of line by line. This is how we do it, my team at least. And I think it's valuable for people to kind of understand this stuff. For this rate, there might be some points associated with it. You know, in this case, about a half a point or $1,800 in costs. There might be an underwriting fee that the lender charged. There might be a processing fee that the lender charged. So in box A of your loan estimate, there's lender fees. Then you go down to box B. Even though we put 700 in there for appraisal, it's really like 550, but we overestimate in case there's a reinspection. But appraisal fee, credit report, flood cert, tax service. Then in box C, you've got title fees. Depending on where the seller opens title, this can vary. But in this case, you've got title coverage, new loan service fee, an escrow fee. In this box might be $2,000, $2,500 in title fees. Then, like I said, you might have transfer taxes. There's recording fees and other taxes that the title company is going to have in there. You're prepaying a year of homeowners insurance. You're prepaying for some property taxes to put a buffer into that escrow account. And then, owner's title policy. Again, some of this stuff might be split. This could vary, but these other costs might add up. You know, there might be some months you close where they've got to collect 9 months of property taxes because a 6-month installment is due in 2 months. And so, that number can vary. But all of these things are going to be lumped in and kind of considered, quote unquote, closing costs. So hopefully that was helpful. Fire away with any and all questions you might have. I'm hanging out in the office today, getting some work done, getting some videos recorded. If you have ideas for videos you want to see, fire away with those too, because I always love to create videos that people click on and they watch, and it's a confusing topic, and then they're like, thank you, that helped. Those are the best. The best comments I get on YouTube was, this is exactly what I was looking for. Thank you so much. You made it clear. I now understand it. How do escrow accounts work is the example I always go to, because I literally, for years and years and years and years, get positive feedback on thank you so much. That explained it. And I knew that it was a common question. I knew that people were curious about how escrow accounts work because I would get clients reaching out every single week asking me how escrow accounts work. So I made a video, and then people from around the country got the same explanation that all my clients got, and hopefully it helped them. So if there's something else you want me to cover, don't be shy. If it's on the replay, leave the comment on YouTube. If you're watching this live, fire it off right now. And I've probably got a couple hours of recording time later today where I'm going to get some of this stuff recorded. But at the end of the day, real-time mortgage education meant to simplify the process, meant to help you understand. The beautiful part of it is when one person or a couple people ask a question and I either answer it live or I make a video and publish it, there's more than just those one or two that get to benefit from it. And that's the goal. I spoke with my team internally, and whether you're a client of ours or not, hopefully the information reaches you and it helps you out. If you're a client of ours, I think that it's worthwhile for me to put out the videos and educate you in advance, because then it makes the process smoother and easier for you as you're going through it. It makes it easier for our operations team because you understand some of the stuff better than you would had you just jumped in and figured it out as you went. And so, yeah, going to continue educating, putting videos out. I got another few minutes, so fire away. Any last questions, I'll get to them, but I'm going to call last call. All right, Ezo Brown. So great question about would I use these steps to see how much house I can buy, meaning max amount. And there's going to be your budget and what you feel you can afford. And then there's going to be the lender's number on how much they'll qualify you for. And you honestly can do either one you want first. And a lot of people are going to start with the lender's number, which I think is, you know, there's no wrong way. But let's say that you talk to a lender and the lender says you qualify for up to 500,000 with 3.5% down FHA. And for a lot of people, it stops there. Then you go hunting and you're looking at houses. Where I want you to stop after the lender tells you you're qualified up to 500,000 is I want you to have a sheet like this, and great lenders hopefully do this. We certainly do this on all our pre-approvals. You take it and you go, okay, well, $500,000 purchase with an FHA deal, all in homeowners insurance, taxes, mortgage insurance. My payment's $39.49. I don't want a payment that big. I'm comfortable around the $3,500 mark. I'm paying $3,200 in rent. I've got some extra money, but not so much that I want a mortgage payment that's $4,000 a month. So you have something like this and you type in 460 and it says 3633. Like, nah, 3,500. As much as I like the houses that are more expensive, 3,500 is my number. And let's see what 440 does. $34.75 a month. All right. I'm comfortable there. And you know, if you want to, you really get technical, you probably go to 442 or 444, whatever the number is, to get you right up at that $3,500 a month. 443, final answer. And so you know that you're looking in that 440 range. And that's a comfortable payment. A lot of people just don't do this. And I encourage you to do this. It's not a lot of work, but it requires a little bit. And I think what it requires more than anything is you looking at your current situation. And as simple as you want to make it or as complicated as you want to make it, it's up to you. You just sit down and you say, you know what? I make $10,000 a month. When you look at my paychecks, $8,250 is what actually goes into my account after deductions. And currently I got $3,200 a month in rent. I've got a car payment that's $550. I've got those student loan payments that are $200 a month. I don't have any credit cards. Good work, because the rates are damn near 30% now. And you do some of that math. And then you realize, yeah, I've been plugging $100,000 or $1,000 a month into savings. So I can afford to go from 32 to 3,500 a month, but 3,500 a month is my number. And then maybe you find the most beautiful house ever and your realtor's like, it's going to take $450. You plug it in, $3,554. All right. Close enough for government work. Since you did the budget, you realize, holy cow, I spent $450 a month over the last 6 months eating out. I'm going to eat out half as much, save $225 a month there. give myself permission to buy it with a payment that's $35.50 a month. Since we're so intimate with budgets and with debt and with debt ratios and all that, mortgage advisors can be pretty good advisors when it comes to budget and finances. So lean on them and ask them questions. If there's somebody else you like and trust when it comes to budget stuff, feel free to reach out to them as well. But this will give you a good base, in my opinion, and you're doing better than 90% of people if you do an exercise like this. Vast majority of people, unfortunately, I want to buy a house. How much do I qualify for? Let's get started. And so it's important in my eyes. So that's that. Let me know if there's anything else I can help with. I'm more than happy to. Thank you so much, Curtis. Videos are awesome, full of great information, only because of the great questions. So keep the questions coming. Leave comments on other things you'd like to see. I'm more than happy to make them. Ezo Brown, you're more than welcome. I have more fun with this than you guys can imagine. I really do. Council Magazine, what's payment shock and does it apply to joint couples applying for a mortgage loan? It's only going to factor in on certain loan types, but payment shock is saying you can't go from $1,000 a month in rent to a $4,000 mortgage payment, a 400% increase. And so based on the loan type you're getting, your lender is going to be able to advise you, hey, listen, with this product, 250% payment shock is all that we're going to be able to do. So even if you did qualify based on your income, this product doesn't allow you to triple your mortgage payment or triple your housing expense from current to new. So thanks for the question. That was great. I got to run. I got work to do. Off to record some more videos. Hope everybody has a fantastic day. Continue to fire away questions on the replay that will live on YouTube in the comment section. Hopefully this helps somebody. Till next time, we gonna see.